All right, class, welcome. Today, we're going to bridge that gap between the mathematics you learn in the classroom and the high-stakes decisions that are made every single day in the boardroom. We're going to talk about a strategic weapon that top managers and financial analysts rely on constantly, and it's something you're already familiar with, at least in form: the matrix. So let's forget the abstract theory for a bit and step inside the world of real business strategy.
So, let's start with a scenario. I want you to imagine you're the head of production at a big electronics company. The board of directors has given you a very clear, very simple directive for this quarter: maximize profit. That's it. The pressure is on. You've got two hit products flying off the shelves, but your resources, the number of skilled workers you have, the supply of microchips, they're all finite. A gut feeling isn't going to cut it when millions of dollars are on the line. You need the single best, most profitable path forward. So where do you even begin?
This situation, this is what we in business schools call the manager's dilemma. And it's a classic for a reason. It's a complex puzzle with all these moving parts, and just guessing or going with your intuition can be a dangerously expensive mistake. The goal here isn't just to make a good decision, it's to find the optimal decision, the one that squeezes every last possible dollar of profit out of your operation. And to do that, well, you're going to need a tool that's a lot more powerful than just a hunch.
Let's get down to the nitty-gritty. Let's say you're juggling the production of phones and tablets. Now, making a phone might be more profitable per unit, but it also takes up more of your most skilled technician's time. The tablet, on the other hand, is a bit less profitable, but it's faster to assemble, meaning you could make more of them. And of course, both of these products need a specific number of microchips, and your supplier has put you on a strict weekly limit. You see the problem, right? Every single choice is a trade-off. If you decide to make more phones, you have to make fewer tablets. If you push tablet production, you might save on labor, but are you going to burn through your entire microchip supply before the week is over?
So how in the world do we untangle this web of variables? Well, the answer is your secret weapon, and the core of our lecture today: the matrix. And no, not the movie. I want you to start thinking of a matrix as the central control panel for your entire production process. It's the elegant, incredibly powerful tool we're going to use to bring some serious order to all this chaos.
So at its most basic level, what is a matrix? It's simply a rectangular grid of numbers organized in rows and columns. But in a business context, it becomes so much more than that. It is, for all intents and purposes, a business dashboard. It takes all of those messy, competing variables we just talked about: labor hours per product, chips per unit, profit margins, and it organizes them into one clear, coherent picture. It allows you, as the manager, to see the entire operational landscape in a single glance.
Okay, so let's actually build one. It's simpler than you might think. Look at this table here. We're going to set it up logically. Across the top, as our columns, we'll put our products, phones, and tablets. And down the side, as our rows, we'll put our limited resources, our constraints, like labor hours and microchips. Now, each cell in this grid tells a story. This number right here, for example, represents the hours of labor needed to build one phone, and this one, the number of microchips for that same phone. We do the same thing for the tablet, and just like that, all that complexity we were wrestling with is now organized into a clean, logical structure. Okay, so we've got our dashboard. The data is organized. Now comes the really cool part. We're going to apply a mathematical technique that uses this matrix to solve our manager's dilemma. This is where we turn that static dashboard into a dynamic, decision-making engine that can tell us the exact production mix to hit that sweet spot of maximum profit. The formal name for this powerful method is linear programming. Please make a note of that. It is a cornerstone of operations research and management science. In fact, it's the mathematical engine behind modern logistics, airline scheduling, and production planning. Don't let the name intimidate you. At its heart, it's a systematic process for finding the absolute best outcome, whether that's the most profit, the lowest cost, or the most efficient schedule within a specific set of rules or limitations. So how does it work? Well, it follows a very clear three-step framework. And if you learn this framework, you can apply it to a huge range of business problems. First, you define your variables. These are the things you can actually control. In our case, the number of phones to make and the number of tablets to make. Second, you state your objective function. This is just a fancy way of saying you write down your goal in mathematical terms. For us, the goal is to maximize profit. And third, you model your constraints. These are the real-world rules of the game that you absolutely must follow, like your limited labor and microchips. It's critical to get every one of these steps right. Let's spend a moment on that objective function. It's simply our business goal translated into the language of math.
So let's say we make $50 of profit for every phone and $60 for every tablet. Our objective function would look like this. Maximize profit equals 50 times the number of phones plus 60 times the number of tablets. This simple equation is absolutely critical. It defines what success looks like for our model. It is the North Star that the entire calculation is going to aim for.
And now for the constraints. This is where that beautiful matrix we built comes roaring back into the picture. The constraints are the rules of the game. So if we only have, say, 4,000 labor hours available in a week, then the total labor we use for phones plus the total labor for tablets cannot be more than 4,000. It's a hard limit. Each row from that matrix we set up directly translates into one of these mathematical constraint equations. The matrix is the model of our limitations. It provides the rigid structure that makes finding the optimal solution possible.
Now, the power of matrices doesn't stop at the factory floor. Not even close. Let's switch gears for a moment and see how this same tool is used in the high-stakes world of financial modeling. Here, it's not just about optimizing products, but about managing risk and building intelligent, resilient investment portfolios.
I want you to think about the most fundamental trade-off in all of finance: risk versus reward. You know the deal. An aggressive investment strategy might promise massive returns, but it also carries a very real chance of significant loss. On the flip side, a conservative strategy protects your money, but it offers pretty minimal growth. So how does a financial analyst find the perfect customized balance for a client?
Well, they use matrices. In portfolio optimization, a matrix can be used to represent the expected returns, the risks, and, now this is the really fascinating part, the correlations between dozens of different assets like stocks and bonds. Here's the key insight. Matrix mathematics can reveal how these assets move in relation to one another. It might show that combining a high-risk tech stock with a stable, boring utility stock can actually lower the total risk of your portfolio because their prices don't move in lockstep. It allows an analyst to scientifically pinpoint the exact mix of assets that will generate the highest possible return for a client's specific comfort level with risk. It turns investing from a guessing game into a science.
But, and this is a very important but, with a tool this powerful, precision is everything. A small mistake in setting up your mathematical model isn't just a wrong answer on an exam. In the business world, it can have truly disastrous financial consequences. We're talking about millions of dollars in lost profit or completely misguided investments.
You have to remember the old saying from computer science: garbage in, garbage out. It is the absolute law when you're doing this kind of modeling. The matrix and the linear programming model are tools for generating strategic insight. But if the data you feed into that model is flawed, if your profit margin is off, if you miscalculate your labor hours, the strategic direction it points you in will be fundamentally wrong. It will give you a perfectly calculated answer to the wrong question.
So let's talk about the common pitfalls, because this is where students, and frankly, even professionals, can get into trouble. First, and most fundamentally, setting up the initial matrix incorrectly. If you accidentally swap the row for labor hours with the row for microchips, your model is dead before you even start. Every calculation from that point on is based on a false reality. Second, misinterpreting the objective function. Are you trying to maximize profit or maximize revenue? They are not the same thing. A model built to maximize revenue might tell you to produce a huge volume of a low-margin product, which could actually crush your overall profitability. And finally, a very sneaky one: ignoring a key constraint. You could build a mathematically perfect model, but forget one small, crucial real-world limitation, like a shipping bottleneck or a machine that always breaks down, and your optimal solution becomes completely impossible to actually implement.
So, as we've seen today, matrices are so much more than just an abstract concept from a math textbook. They are a practical, powerful, indispensable tool for any manager. They allow you to take complex, messy, real-world data and transform it into a clear, actionable, and truly optimal strategy. The real question I want to leave you with is this: when you find yourself in that manager seat with this tool at your disposal, what business problem will you solve first?